Crypto prices have skyrocketed in the last year, giving investors mind-boggling returns. According to Chainalysis, in Indian households, investments in cryptos grew from about $200 billion to nearly $40 billion in the past year. Regulatory uncertainty no bar, new and many investors are finding favor with this currency, which is now finding parallels being drawn with gold. Cryptocurrencies are a new investment class with very little data for investment, research, or past performance to check on. So, if you are a new investor getting lured by these returns and planning to dip your toes into this water, here are 7 thumb rules for you to make an informed decision when entering this high risk, high reward arena. Number 1. Don't go all out. The phenomenal returns given by some cryptos in the past 1 year are mouth-watering indeed. Rupees 10,000 invested in Dogecoin 6 months ago is now worth Rupees 5.75 lakhs. But don't get carried away by these numbers and take large bets. Invest only what you are willing to lose. Even if you have a high-risk appetite, start small. Don't allot more than 2% of your overall portfolio in cryptos, point out experts. After you get familiar with this arena, learn about the various coins available and understand their value and prospects before allocating more. Number 2. Prepare to stomach intense volatility. Investing in cryptocurrencies is the best way to learn about them. But in this high risk, high reward game, you must have the appetite for extreme volatility. Bitcoin smashed through $50,000 in February, and as the May 2021 crash has showed, an overnight fall of 70 to 80% can also be expected. Keep in mind that even a blue chip like Bitcoin was down 48% from its April high of Rs 50 lakh. Number 3. Use reliable platforms. One of the biggest barriers preventing wider adoption and acceptance of cryptos is the surrounding regulatory uncertainty. Last year, the Supreme Court of India squashed a 2018 rule banning crypto trading by banking entities, resulting in a trading surge. The crypto space continues to be unregulated in India, and new outfits crop on a daily basis. Though the Supreme Court has recently struck down the RBI ban on cryptos, and even the government has hinted at taking up a calibrated approach towards industry regulation, thus providing more certainty, investors need to be careful when choosing the intermediary that they want to go via. Investing via an overseas platform may require greater compliance even on the tax front. Number 4. Verify all the information you receive. Another byproduct of the said unregulated nature is that crypto arena suffers from a major deficit of legitimate information. Now, investors are dependent largely on unverified information circulating on social media, and sadly, as we all know, social media these days has plenty of fake news. Self-styled crypto analysts create WhatsApp groups in bulk, packed with their accomplices who vouch for their accuracy and potential. These analysts trap gullible investors first by charging a fee for the tips they give and then using for their pump and dump operations. Yes, these pump and dump operations are found in the crypto space as well, not just in the stock market. So you must verify information before you invest. Check the market cap and trading volumes of the coin you're choosing. A low market cap and insignificant daily volumes are of course clear red flags. Number 5. Focus on the blue chips. Like the stock markets, the crypto markets also have blue chips, mid caps and penny stocks. Don't hoard obscure coins just because they're available at cheap valuations and you can get plenty of them. Bigger coins may be costlier but are more stable and definitely more reliable. In fact, you need not worry about the costliness at all since you can just buy in fractions. Bitcoin is the blue chip or the blue chip standard of the crypto space and drives the overall market sentiment. Focus on the blue chip coins like Bitcoin and Ethereum with some of your money in emerging coins like Dogecoin. Number 6. Keep an eye on global developments. The crypto market has a global footprint, which is why global developments can impact prices, so one needs to keep up with the happenings in the key markets like US, Singapore and Europe, regardless of his or her own geography. Crypto trading goes on 24/7, unlike in case of stock markets that have opening and closing bells, so one can even act immediately. And lastly, number 7, take note of the tax aspects. There will be tax payable on the income from crypto trading. Even though cryptocurrencies are not specifically mentioned in the Income Tax Act, not yet at least, Income in any form from any source is taxable unless specifically exempted under the Act, point out experts and advisors. Cryptos are not considered currency by the RBI just yet, so they must be treated as capital assets, meaning short term gains will be applicable and will be added to income and taxed at normal rates, while long term gains will be taxed at 20% post indexation. Basis the volumes and frequency of trading, the corresponding income can also be categorized under business income or the business head. That's all from us in this video. Make sure you've noted these 7 points before you go skinny dipping in the crypto space. And don't forget to check out EP Wealth Legal, EP Wealth's latest offering and your go-to guide on all matters related to succession and estate planning. Stay tuned and stay safe.